And let's welcome on board Anuj Puri, Chairman, ANAROCK Group, joining us on the show right now. Hi, Anuj. Good to be speaking with you. Firstly, when it comes to the real estate demand, give us some sense that what's been really happening in terms of the demand for the premium luxury. Because, well, of course, we will talk about the other spaces like malls, how is the demand shaping up. But the headline that we all read is that some of the properties and some of the luxurious properties in Gurugram that are gaining traction yet again. So help us understand how is the sentiment catching up?
Yeah, good morning. Always nice to be on your show. In sort of 60 seconds, I'll cover all the three sectors, the office, residential, and then we can go a little bit more detailed on the retail sector. Just quickly on the office sector, doing exceptionally well at this point in time. Nearly 80 million square feet was leased for the last financial year, which was the best ever since independence of India. So again, office is a bad word. If you were to look at more mature markets in India, doing exceptionally well, largely backed by GCCs, American corporates who are coming in and setting up their own captives in India, and hence requiring a huge amount of office spaces. On the residential, clearly the luxury seems to have come back. It had slowed down January, February, and I would say till mid of March. But in the second half of March, and again, we've seen back in April, there has been a fair amount of velocity of home buyers. Maybe it is the stock market that has rebounded. Maybe it is that the tariffs are starting to settle, as a result of which the home buyers who were in the luxury space have had the confidence come back, as a result of which they are back into the market, and the demand continues to remain robust after a brief halt in January, February, and mid of March.
Interesting. So, Anuj, tell us a little bit more, firstly, about how commercial rates are doing. And, it's very difficult to analyze even city by city, because even in cities, different areas, command different kind of values. But let's talk about, Mumbai, BKC, Gurugram, where you're seeing large concentration of commercial properties.
Yeah, I think it's a very interesting question. I'll give you a thumb rule. Majority of the IT destinations, whether it's Bangalore, Chennai, Hyderabad, Pune, the rental is $1 a square foot a month. Now, because the dollar has been appreciating, so as a result of it, the rents have been appreciating. But it has been the same over the last 20 years. $1 a square foot a month. At that time, dollar was at 40 rupees to a dollar. Today it's at 85, as a result of which the rent has gone up. But for the American corporates, it continues to remain a huge cost arbitrage, because they are paying 20 years ago $1 a square foot a month for office rent. Today, they continue to pay the same largely for the IT cities. When it comes to Mumbai, BKC, I'm telling you, I have no idea what's happening in this market. Crazy amount of rental growth that we have seen since COVID. I mean, at the end of COVID, it used to be about 250 rupees a square foot a month. And it has now jumped to 450 rupees a square foot a month. A lot of the front offices, investment banks, retail banks, private equity wanting to take space in BKC, as a result of which the rents have really jumped. Also there hasn't been much supply that has come in the BKC market. So this remains a big anomaly where we have seen 60, 70, 80% jump over the last 2-3 years in terms of rentals. As far as Gurgaon is concerned, there it's about $2 a square foot a month. And that has been a very stable market, largely dominated by DLF across the board, and has a mixture of both front office and back office. But I would say, as a thumb rule, $2 a square foot a month.
We see that the rise of the Tier 2 and the Tier 3 cities at the retail hotspots is a standout trend. Now, with e-commerce share in the cities at almost 56% and expected to touch higher by FY30, how are the malls evolving to remain relevant in these markets?
It's an interesting thing. I thought, during COVID that malls were going to be passé. I mean, the way that they have come back, the rebound, the footfalls that we are seeing in these malls, whether it's tier 1 cities, tier 2, tier 3, perhaps tier 2, tier 3, to your question, even better than tier 1 cities. We're just amazed. We thought that online was going to eat up the physical retail space, and there would be not many retailers who would want to expand on the physical retail. Contrary to that, we're seeing that many of the D2C brands, which were the online brands, are wanting physical space. So the retail is moving away from physical and digital to phygital. And the demand is largely coming in from these D2C brands who are saying is we need physical space. We're doing very well online, but we do need prominence. We do need branding. The cost of marketing on the digital is quite high, as a result of which, we do want spaces in the malls to be able to get more to the public and build that brand. Not only that, last year there have been 60 foreign retailers who have come into India. Many of them are keen to get into tier 2, tier 3 cities. These are on the fashion, lifestyle, F&B doing, superbly well at this moment in time, entertainment. So as a result of which, the physical retail space has seen a fair amount of bounce back over the last, I would say, is 18 to 24 months.
At what point in time the affordability factor kicks in? I'm just talking about the affordability factor in terms of footfall, affordability factor conversion of footfalls. There has to be a commercial aspect to a mall in terms of rental and footfalls and conversions. How is that arithmetic looking?
So a good question, Nikunj. Clearly there is a fair amount of churn that we see in the malls. Unlike in the office space where the office developer is not very happy with the churn in the occupiers of the office, on the retail, the mall developer is very happy with the churn. And they're happy with the churn because they want newness. They want people to come in and see is that, okay, these are the new brands. As a result of it, the footfall continues to remain in. And in many cases, the mall developer makes it at such a level that it only will attract good quality brands who can afford. Otherwise, they are very happy to churn. These are also short leases, unlike the office leases, as a result of which legally the mall owner has the ability to be able to churn the tenants. So to answer your question, yes, affordability does breach in many of the occupiers, but the developer is very happy to move them out because there are 3, 4, 5 occupiers waiting to take that space which has got vacated. Nikunj, just very quickly, I'll give you some numbers. Last year, 24-25, the new mall supply that came up was only 1.1 million square feet. And the leasing activity that took place was 6.5 million square feet. So clearly the demand was far outstripping the supply, as a result of which for each of the shops that was getting vacated, there were 3, 4 occupiers already waiting to enter, that retail outlet. As a result of which, we've seen the rental growth happening. And you'll pick up any of these listed companies, you'll see that there has been in the same malls rental growth happening. But we are now this year looking at a fairly good supply that will hit into the market of grade A quality malls. But the demand still continues to outstrip the supply. So in terms of supply, we believe about 6 million square feet, which was 1.1 million square feet last year. Supply should hit the market in the financial year 25-26. But the demand is going to be between 7 to 7.5 million square feet. So again, it outstrips the supply.
So good having you on the show. Thanks for your time, and good to get in that perspective on what's really happening on all residential, commercial, and how the rentals are actually moving, currently in across country.
If you like this video, then like, share and subscribe to ET Now.